Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay. With me, as always, Nigel D'Souza, and Rima is keeping us company through the week. And guys, what a roller coaster we've had, right? But I want to start with a bit of optimism because you remember before closing bell yesterday, we started noticing the fall in US futures and the fact that this whole Trump commentary is scaring markets. So I don't know. I mean, I'd like to believe that we've kind of preempted the global fall.
Well, that's right. But when you wake up to the US markets losing more than $1.5 trillion overnight, whoopsie daisy. That's telling you that the US markets are under pressure. But I take that point. Maybe the Indian markets preempted something. And I guess, this is the time not to be very, very brave, but not to be silly and throw in the towel. I think that's going to be important.
Wise words.
Indeed. Hi, good morning. So, red day or not a red day?
He's wearing maroon. I
think it'll be a little less red by the time we wind up, but that's the optimist in me speaking. So let's see how it goes.
Okay, so let's get started. Lots and lots of cues to track and plenty of headlines. I mean, in overnight action, so much going on. So let me dive straight into it. The question that the street is asking and that global market participants are asking is that is the US manufacturing a tariff-induced recession? That, in essence, was the one line that was playing out on market participants' mind, and that is why we had this big sell-off. So what have we seen? We've seen about a 2 to 4% collapse on U.S. indices. The NASDAQ took it on the chin, down about 4%. And it's not just, equities. We saw that risk aversion play out in bonds and cryptos. I'll come to all of that in just a minute. But yes, tech is where the troubles really were paramount. So you had big stocks, Apple, Meta, the likes. All of them were down between 4.5% to 5.5%. But again, it wasn't just a tech-centric sell-off because even the Dow and S&P 500 sold off. Big U.S. banks, Wells Fargo, JP Morgan, Bank of America, these stocks were down between 4 and 6%. The concern is the U.S. grinding itself into not just a slow growth patch, but a recession? So just going back to where it all originated, now Mr. Donald Trump was on Fox News on Sunday. Actually, our market started reacting to this last afternoon, which is why I'm saying, have we preempted the fall? And in that interview, he was asked whether the U.S. recession is a possibility, and he didn't outright deny it. He didn't blast it off as a nonsense idea in his trademark style. He actually said that the U.S. economy is going through a transition. And the fact that the U.S. president was very matter of fact about it is what scared the market. Because this market till now has been working on the belief or the premise that the US president will do whatever it takes to keep Wall Street, soaring. And now that's coming under a bit of a cloud. So let's talk about the other asset classes. Equities we've discussed. Yields were down about 9 to 10 basis points. The US 10-year and the 2-year. There was a flight to safety. People were moving to bonds. The US 10-year yield, in fact, last I checked, was about 4.1%. Yeah, still below the 4.2% mark. 4.16 was the low. Now it's at 4.18 as we speak. The dollar anyway has been faltering. And even yesterday, the levels were on the DXY. They were largely below 104. And again, that flight to safety means a move towards the yen. Yesterday, the dollar fell almost 0.75% to the yen. 146.6 was the session low yesterday for the dollar as the yen continued to soar higher and higher. This morning, sort of slightly off that mark. But anyway, the yen and the Swiss franc is where the money has been moving as the dollar continues to be under pressure. Then move on. Cryptocurrencies, they weren't spared either. The slide was between 6 to 14%. Many of the other Bitcoin was down about 6-7%. Ether, Solana, these currencies were down between 12% and 14%. The Bitcoin is now at November lows, November 24 lows, falling below the 80,000 mark. So that's what was playing out in cryptos. Oil was part of this whole global sell-off as well. About a 1% decline. Brent is below $69 a barrel last I checked, which is a good cue for India, actually. It's a very, very positive cue. But that's how it was playing out. Now, it's a very data-heavy week for Wall Street, so we have to keep our ear to the ground, and the markets are really holding their breath on a couple of numbers. First is the consumer inflation number, which will come out on Wednesday. Then the producer price index comes out on Thursday, and the consumer sentiment indicator, the University of Michigan survey, that comes out on Friday. And all these data points will actually map a more clearer picture of the U.S. economy, which is the reason behind the correction. Now, India was caught up in this global storm yesterday itself. The question really is that whether India can continue rising in the wake of bigger US troubles. Now, this is the fall in the last 1 month on the US indices. You can see the Nasdaq has really taken a big hit, down almost 11.5%. So the question is the US exceptionalism faltering? The answer is yes. But can India be a direct beneficiary of that? That is the point of debate, and we'll discuss this with our market experts as we go forward. Let's see. Maybe we start slightly soft. Asian markets have been weak as well, but maybe we'll pick up from there. Lastly, on the local front, I just want to leave one more point on the radar, and that is IndusInd Bank. In addition to all the global issues, what IndusInd Bank reported yesterday, the fact that there are accounting discrepancies in their derivatives portfolio. This is Forex derivatives, I think, that they're talking about. And that could be to the tune of almost 2.3% of their net worth. I mean, the disclosures to come in now, yesterday was about Mr. Sumant Katpalia not getting a 3-year but a 1-year extension. So it's something that makes the market nervous. It's not something that the market likes to hear of, especially in large cap blue chip stocks. That's another issue that we have to contend with. But let's see, bracing for a bit of a rocky start.
Indeed, and the amount is quite large, right? IndusInd Bank's net worth is 65,000 crore rupees. So we're talking about, 1,500 crore in terms of a discrepancy. But, the Indian markets have already fallen 15 to 20% from their peak level. Just to map up the US markets and the fall from the peak. So the Dow is down close to about 7%. The S&P 500 has closed 8.6% from its February 19th high. It's shed over $4 trillion in terms of market value from its high. And the Russell 2000, that's the small cap index. So the stock market turmoil has taken the Russell 2000 closer to bear market correction with a near 18% fall. The good thing back home is that the FI selling appears to, coming closer to exhaustion levels. So yesterday, the FI net sell was sub 500 crore rupees. The DII's net bought about 264 crore rupees. And that FI selling over the last couple of days and how it's abated will also come up for you on your screen. Now, in terms of cues to track, today is Sensex weekly expiry. Levels to watch. For the last 2 days, the Nifty on an intraday basis has been taking support between 22,400 to 22,450. So the first port of support for the markets would be the range of 22,400 to 22,450. But after that, the recent swing low on the market was a level just sub the 22,000. Remember, we all said that important resistance for the markets kick in between 21,800 to 22,000, and the recent swing low will be, come up. Asia is deeply in the red following the rout on Wall Street. Nikkei is leading the losses there. Nikkei, the Japanese index, is down close to about 2%. The Q4 GDP print coming out of Japan was lower than street expectations, revised down to 2.2% versus a 2.8% prior estimate. So now all questions are being raised whether Bank of Japan can go ahead with that expected rate hiking cycle. March policy, possibly a hold, but maybe in May they could go ahead with a rate hike. And not to forget, in terms of the Trump tariffs, tomorrow the blanket 25% tariff on aluminum and steel on producers across the world comes into effect. So 12th of March, will there be a delay or will it go on as scheduled? That's up in the air.
Well, that's right. A couple of observations here. The GIFT Nifty suggesting we pull back only around 0.4%. That's 0.5% odd. I won't be surprised if it's a little bit wider in the initial ticket sell because the global markets are down between 2 to around 3%. And the other point is maybe not go in whole hog, but for a longer term investor here in India, it's actually a very, very good time, I think, so to start chipping in. Don't go in whole hog, but don't throw in the towel. That's going to be important. And as you all mentioned, yesterday it seemed we preempted that maybe, in fact, the US markets are going to have a wobbly trading session. So you put that 0.5% decline yesterday and 0.5% to start off with. Maybe we factored in some part of the bad news overnight in the initial tick itself. Let's take stock then. Let's look at a couple of pauses. We've been telling you about how dollar index has cooled off. Brent crude prices as well have stayed lower. Well, both those two are good. A couple of other positives. The net long positions on the dollar, that's come down by close to around a half. In January, the net long positions in the futures market were close to $35 billion. That's come down to sub $20 billion. So those net long positions have declined. And, it's weighed on the dollar index as well, which is good from an India market perspective. Because of the weak data prints that we have got in the last few weeks coming out of the United States, now suddenly there's that chatter of 50 to around 75 basis points cut going by various, global agencies that track this particular data point, and the Fed futures as well is indicating that maybe we start getting rate cuts. I just recall, a few weeks ago, people were talking about no rate cuts. So that's another, positive in the sense there'll be liquidity into the system. Moving to the sell numbers. The FIs, yes, they continue to remain net sellers, but now that number is sub 500 crores. In yesterday's trading session, both the institutions, in fact, the buy number from the DIs as well as the sell number from the FIs were much lower than the averages that we've seen. So it appears in yesterday's trading session, there was more or less, the weak hands that were selling into the market. It wasn't institutional-led selling that we saw in yesterday's trade. Another factor comes up for you on the screen. Yesterday, you were wondering, the March futures came down drastically from around 100 points to around 55 points, but there were no big shorts in the system. In fact, there was some unwinding of open interest out there, telling you that there were some net longs that were unbound as well. And another factor that could have played out was the FI. Well, on the stock futures, they have been net long, but in yesterday's trading session, they unbound more than 20,000 long contracts, which could have weighed on the markets as well. Moving to how are they positioned? Mild shorts were added yesterday, mild unwinding in longs. Well, the short positioning continues at around 82% or thereabouts and at around 1.8 lakh contracts in absolute terms. Options data comes up for you on the screen, and that's very, very important because the call writers, they feel they're back in the game. Even in yesterday's trading session, there was aggressive writing on a couple of calls, while this put, the 22,000 put, is the most important level that you're looking at. So let's get the levels up for you on the screen. The recent low, that becomes the important support zone. And in fact, the 20-day MA, that's important at around the 22,700. So that's the range. You don't want this level to break on the downside. And with today's trade, the 22,500 odd mark will be a bit of a resistance, in fact, in case we get up and going. The Nifty Bank, well, yesterday that was a little bit subdued as well. This is a crucial support zone that we've seen. Last week, we almost went to this mark of around 47,800. So that's going to be important. That's the important support zone. Recent high becomes a bit of a resistance. So there are going to be three pillars in trade today. The Nifty IT index could be a little bit off color because what happened to the NASDAQ. So it's on to the Nifty Bank and big boy Reliance Industries. They'll have to find their form. But by the end of today, maybe, just maybe, it's not as bad as the first 60 minutes or so because the Nifty could easily be down more than 0.5%, but then don't rule out a bit of a pullback.
I think one thing is for sure, guys, that maybe they don't do it today, these FPIs, which is quickly run to a market like India. Yeah. But what's happening in the US will force people to rethink their long-only, US-only strategies. They'll go back to the old market adage that you cannot have all your eggs in one basket. And that perhaps should be a boost and a benefit for us. Anyway, let's move on and start off with the equity call of the morning. Jonathan Garner of Morgan Stanley thinks that Asia EM equities can continue to show low beta to the ongoing decline in US equities. He says they continue to emphasize domestic revenue over US exposure, which means Japan with a focus on financials, real estate, trading houses and defense, China with a focus on internet and e-commerce, domestic tech, hardware and financials, and India with a focus on financials, industrials and consumer discretionary, as well as Singapore and UAE on financials and property. He says they stay underweight Korea, Taiwan, and semiconductor and tech hardware, would avoid low-quality growth as a factor. So that's Morgan Stanley. Bullish views continue on India.
Well, it's time now to get in some global opinion on the markets. Stephen Eglander, Managing Director, Global Head of G10 FX Research, North American Macro Strategy at Standard Chart, and Matt Orton, Chief Market Strategist, Raymond James Investment, are now joining us on the show. Gentlemen, thank you very much for joining us this early India time. I'm sure it's very, very late for you. Stephen, let me start with you and get your thoughts on the possibility of a U.S. recession. Donald Trump says the U.S. economy is going through a period of transition. Treasury Secretary Scott Bessent says there could be a period of detox for the U.S. economy. Are the fears of a U.S. recession overblown, or is it a legit concern?
Well, I think President Trump sees early 2025 weakness as a freebie, in the sense that if he raises the alarm and it happens, he can blame the previous administration. If it doesn't happen, he can take the credit for himself. Market sentiment has deteriorated a lot, but I think well beyond the deterioration in the data. The big increase in the trade deficit that mechanically pulls down GDP is very misleading for a number of technical reasons and shouldn't be paid attention to. And I'd say that with energy prices coming down, and the weather improving, we're probably going to see more room for consumer spending in March and beyond. So we do think the economy is slowing, but nowhere near the pessimism that's being expressed.
Okay, well, right now it seems to be, maybe then it's a knee-jerk reaction in the market. Stephen got that. Let me ask Matt that question as well. Matt, great to have you on the program. So, I want to ask you what we were sort of theorizing over here just a while back, whether the events of the last week and a half, last 2 weeks, which have been really quite brutal for U.S. equities, whether they will lead market participants to finally look out of the U.S. Is this whole U.S. exceptionalism coming under a bit of a cloud till this tariff issue finally settles and resolves and we finally know the numeric impact?
Good morning, Surabhi. It's always great to join you. And I think that's exactly what's unfolding. While I'm not in the recession camp for U.S. equities, I fully agree that growth is going to slow down. But I think what U.S. investors are being reminded of, and kind of a key theme of mine heading into this year, is that diversification is really, really important. And you can diversify your portfolio not only within U.S. equities across industries and sectors, but you can also do that through asset classes and also through geographies. And so we just saw one of the strongest 4-week inflows to European equities that we've had over the past 10 years. So the flows that we're seeing into Europe and out of the US are very, very real. And I think a lower dollar, just like we talked about a few weeks ago, that is the critical piece to spurring emerging market equities and I think having some sustainability behind that. So I do think that U.S. investors are looking elsewhere. I'm traveling this week meeting with clients, and that is a sentiment I'm getting, is really interested clients asking where else can we look in this market where we're not going to be leaning into momentum, which is what's not working, and where can we find some growth that might not be at risk of a growth scare like we're seeing in the U.S. And I think India does fit that bill. It might take some time, but I think there's definitely interest.
All right, that'll be good news, Matt. And you've been quite positive on the Indian markets as well. Let's come across to you, Stephen, though. Tell us how you're reading the global central bank action. In the last couple of weeks, we've got some weakest data coming out of the United States. It could be temporary in nature. But suddenly, the Fed futures, they are factoring in a couple of rate cuts from the Fed. Do you think that's going to happen this year? And also tell us about the Japanese central bank, because the other fear was there's a possibility that they go in there and hike interest rates. But suddenly the data out there is not up to speed as well. So what are you expecting from both these two big central banks?
Well, Japan to do more and the Fed to do less. The Fed doesn't have that much time to cut rates because there will be a fiscal bill. It's likely, technically it will be paid for, but I think there'll be a lot of doubts that it's going to be deficit neutral. I think by the time we get into the second half of the year, and certainly as we get well into the second half of the year, the Fed will be very hesitant to cut rates. So, we've had 2 cuts for a while. We think that that's pretty reasonable. The market now has 3.5. I think that's a bit exaggerated. In Japan, the GDP number was revised down a bit. I think it's one number. Overall, the Japanese economy isn't doing badly. And the wage side and the inflation side is doing well. So we still expect 2 hikes from the BOJ and basically, the yen to continue to outperform other currencies in coming months.
So the BOJ hikes twice this year and the Fed cuts twice as well. 50 bips is what we should work at, 25 to 50, or that as well may not come about?
Right. Correct. We think that the Fed will cut in Q2 and it'll cut in Q3. But after that, it's going to be very hard for them to cut given the fiscal tailwinds that the U.S. economy is going to have. Whereas, Japanese real interest rates are still very low. And, every central bank thinks it can control inflation. But once inflation sort of gets out of the corral, it's really hard to bring back down. So we think that they'll end up doing more rather than less.
Stephen, then how is it or what is it that makes you not too concerned about overall U.S. growth? I understand you're not in the recession camp. But if we put all of this together, the impact, first of all, tell us, what do your models say? What could be the total impact of these tariffs? Some people argue it could be as much as 1% of GDP. There's obviously inflation that's becoming an issue. Do you see stagflation becoming a problem for the U.S.? What really lies ahead in the next, say, 1 or 2 quarters for the U.S. economy?
There is a risk of price hikes accompanying tariffs. I mean, it makes no sense to argue that it's not going to happen. Historically, that's been the case, and it's unlikely that currency moves will absorb all of the tariff increases. I think that they're pulling back, say on the tariffs on Mexico, the tariffs on Canada, reflects the fact that they're coming to realize that tariffing trading partners, especially essential trading partners, is more complicated than it looks. So I suspect that the net, overall will be, single digits in tariffs, probably not double digits overall. Some noticeable effect on inflation, but not, not something that's a game changer. I do think that they're determined to use fiscal to get taxes and to re-stimulate the economy. And that part, I think, is going to be dollar positive towards the end of the year. And, it's going to push rates back up again. I think the market, playing with fire a little bit and taking yields as low as they're doing right now.
So you expect, you said dollar positive. We've seen the dollar index, Stephen, come down from levels of more than 110, now down to sub 104. Reciprocal tariffs come into effect from early April. What's the call on the dollar index and the US 10-year yield?
Well, look, the dollar might weaken in the short term for all the reasons we've been discussing. We expected the U.S. economy to slow down in the first half, and it's slowing down. The Fed is likely, they can cut a bit and then raise rates if they have to. So I think that we're in a dollar correction. We're not in, switching to a 5-year dollar downtrend. I think that when we get the stimulus in the second half of the year, rate differentials will reassert themselves and the dollar will be stronger again. So, enjoy the dollar weakness while you can.
Oh, okay. Enjoy the dollar weakness while you can. That's interesting. So yields in the dollar are heading higher. That's what Stephen's view is. Matt, just very quickly, equities. You've always been a fan of Indian equities. But now against this new backdrop, what would your advice be to investors on India?
So my advice to investors in India is the same as it is globally. Right now, you need to lean into quality companies. You need to identify companies where you're seeing earnings continue to move higher. I think those companies do exist. Some of the names we've discussed before, like Bharti Airtel, which has been a holding that I like, that has held up very, very well. And I do think there's going to be buying opportunities in financials in particular. I think what Indian equities have to look forward to is the fact that they've already gone through the growth scare. That's really what we're seeing unfold in the US right now. And with that in the rearview mirror, as investor sentiment starts to improve, and if the dollar does remain weaker, I think that's going to help move flows back into the market because there's already been a valuation adjustment, there's been a growth adjustment, earnings forecasts have reset. So I do think there's an opportunity. I want confirmation though. I'm not adding any new money until I start to see the technicals improve because I'd rather be a little bit late than too early and still have a little bit of the bottom fall out.
Okay, and Matt, just taking a final sort of chance on this, I'm not sure, since you do look at some of the large cap Indian stocks and banks particularly, I don't know if you caught the headlines that are coming out this morning, actually last evening India time, on IndusInd Bank. They have some accounting issues with some of their derivative positions, trading portfolio, and that could cost the bank a couple hundred here and there. I don't know if you saw the news. Any thoughts on IndusInd, if at all you've had a look at it?
So no, Surabhi, I haven't had a chance to look at the specifics there. But again, I think it just highlights the reason why you need to lean into quality and also know the companies you own. Obviously, there's some situations you can't forecast going forward. But in this market, I would sell and trade for banks like ICICI or HDFC, ones that have incredibly solid management teams where you're not going to run into these issues.
Okay. All right, gentlemen. Thank you very much. Appreciate you both being with us on the show this morning and giving us perspective both on the US and as well as how to look at the Indian market in this context. Thank you for joining it. Well, with that, we have to quickly move on. Let's tell you what else is lined up on the show. You've just heard that global conversation coming up ahead, lots of corporate interactions. We also have Oswal Financial Services. At 9 a.m., we'll have Amit Dikshit of ICICI Securities for the next financial year, FY26. After that, Jairam Sampath of Keynes Technologies will be with us. We discuss, of course, we'll be speaking to the managements of Shree Cement to understand what the cement industry dynamics are like. And a little later,
track for you today, we'll get to that in just a bit in our special Top 10 segment. We're looking at Hitachi, HEG, Bharat Electronics, Anupam Rasayan, Navin Flori.
Welcome back. Brace yourself for a bit of a gap down, not as sharp as a sell-off on Wall Street, where the key indices were down between 2 to 4%. But it looks like the unwinding will continue in the Indian markets. Yesterday, the Nifty and the Sensex were down close to about 0.3, 0.4%. The mid-caps were down 1.5%. And the Nifty implied open suggests a gap down of 100 points. What about individual stocks? Our research team is standing by with CNBC-TV18's list of top stocks for the day. And the stock of the day on the way down could be IndusInd Bank. Abhishek joins in with the details. Abhishek.
Well, Rima, IndusInd Bank could hit another 52-week low in trade today, given the fact that they have given an update wherein the internal review of processes with respect to asset and other liability accounts of derivative portfolio has shown that about 2.35% of their net worth will get adversely impacted. So calculation shows that this would be around 1,580 crore post-tax and about 2,100 crore pre-tax with respect to the liability that will come up for provisions. So they have appointed an external agency to review and validate the internal findings. The bank's profitability and capital adequacy ratio remains healthy to absorb this one-time impact. The management did held a con call for analysts yesterday, wherein they mentioned that the practice has been ongoing for 5 to 7 years and was discovered as a part of the review initiated following new RBI guidelines with effect from 1st of April 2024. So CEO's one-year extension versus the 3 years that the board had sought acknowledged to be influenced by this issue as well. So analysts do say that there is one-time earnings impact, but this can lead to short-term derating of the bank. So some of them have cut their earning estimate anywhere between 20% to as high as 25%. We have MK as well as Jefferies and Citi who have reduced the target price on the stock. In fact, MK has downgraded the stock to add from buy. Back to you.
Okay, so lots of brokerage views coming in, pointing out these issues and how they've come as a complete surprise. Thanks for that, Abhishek. So that's the numero uno stock that we'll watch out for. Several others as well. Let's move to the others on the list. Vamakshi is joining in. Vamakshi, morning. Why are you watching out for Hitachi Energy?
Well, good morning, Surabhi. Hitachi Energy is expected to open higher today, and that is because Hitachi Energy has launched its QIP yesterday. The base issue size is worth 2,000 crores. They also have an option to upsize this to 3,000 crores. The floor price for this issue has been determined at 12,112.50 per share. This is coming in at a nearly 4% discount to the closing price on NSE yesterday. The indicative issue price is at 11,507, which is at a 9% discount to the closing price yesterday. This could lead to a dilution of up to 6.15% at an indicative issue price, and largely the proceeds will be utilized to fund the capex requirements of the company. Keep in mind that a couple of months ago the company had announced capex plans worth almost 2,000 crores, so a large chunk of it could go towards this. In addition to that, they could also utilize some of these funds for working capital requirements as well as for general corporate purposes. So given this development, going with the green for Hitachi Energy, the stock has been under pressure over the last 2 sessions.
Okay, all right. Thanks a lot for that, Vamakshi. Well, I'm looking at HEG. I'm going with green on that one because they've proposed value unlocking in Bhilwara Energy, in which the current listed entity has around 49%, while the remaining 51% is with the promoter entity. Now, BEL, that's Bhilwara Energy Limited, they have approved a fundraise of up to 500 crore rupees. Singularity AMC, that, in fact, that's the one that's coming in there. And the focus really is accelerating its energy transition businesses. Remember, Singularity is backed by Mr. Madhu Kela, who's a noted investor. Now, Singularity AMC will hold close to 9.6% stake in Bhilwara Energy for initial 250 crores. They have an option of putting another 250 crores. So 250 crores will be put down. Another 250 crores could come in later. Due to this transaction, HEG's stake will come down to around 44% from around 49% in Bhilwara Energy Limited. And as per the earlier scheme that was announced, BEL, well, it will be merged into HEG Limited. And HEG Limited will house the green as well as the renewable energy part of the business. The other part of the business will be the current core business, which is the graphite business. The promoter stake in HEG Limited, the one that will house this green energy business, will now be around 60%. Remember earlier, before this dilution in BEL, it was going to be at around 70%. So net, it's a positive because there is some value unlocking in one of the subsidiaries. That's why, in fact, expect the stock to open up with the green.
Okay, all right. So that's HEG. Watch out for this one. Let's move on. We have a couple of other names like BEL, Anupam Rasayan and Naveen Fluorine. And Upasna is joining in to tell us why all of these are in the news this morning. Upasna.
Well, good morning. First up, let me start with BEL. Continuous slew of orders for this stock continues to remain in focus. Now, companies received orders worth 843 crores since 6th of March 2025. With this, the company's total accumulated orders received for the current year stands at 14,567 crores. Mind you that the company needs order worth additional 10,433 crore to meet its annual guidance, that is 25,000 crore order inflow guidance given by the company for FY25. Moving on to Anupam Rasayan, the company signs a 10-year letter of intent worth 922 crores with a Korean MNC, which is a leader in specialty chemicals for a high-performance niche chemical expected to be supplied from FY26. And lastly, Navin Fluorine will also be in focus today as the additional 4,500 TPA hydrofluorocarbon R32 plant goes on stream in Surat. And mind you that the additional capex for this plant incurred by the company is around 84 crores is what they have indicated. So all in all these three stocks remain in focus, and I expect all of them to open in green today.
Thank you very much for that. It's back to Vamakshi for more stocks which are in the news.
Well, good morning, Reema. First up is Thermax. Thermax Chemical Solutions, which is a wholly owned subsidiary of the company, has entered into an agreement with Oswaldo Cruz, Brazil. They will be establishing a new company in India, and this is being done to set up a dedicated production facility for manufacturing acrylic resins in India. Now, keep in mind that Thermax Chemical Solutions will hold 51% stake in this new company, while the other entity, which is Oswaldo Cruz, will hold nearly 49% stake, and the new company will enable the Thermax Chemical Solutions to strengthen its portfolio offerings in the chemical space. So going with the green for this counter on the back of this news flow. Syngene is the next counter we're watching out for, going with the green for this one as well, and that is because its arm has acquired its first manufacturing facility in the US from Emergent Manufacturing Operations. The overall investments in this US facility is expected to be somewhere around $50 million or somewhere approximately 436 crores in rupee terms. This facility will be available for client projects from the second half of 2025, and in the short term, they're expecting minor dilution of operating margins on account of the cost that will be associated with this acquisition. Lastly, let's focus in on Ashoka Buildcon. They've received a letter of acceptance for MSETCL project worth almost 312 crores. So going with the green for this counter as well.
Okay, all right. Thanks a lot for that, Vamakshi. I think there's one more stock that you're tracking, Star Health. Tell us more.
Well, good morning, Nigel. Ahmedabad hospitals and nursing homes have actually suspended cashless services for policyholders of Star Health as well as Tata AIG General Insurance. The cashless, claims will not be available for policyholders starting from April 1st. And the reasons why they have suspended this is on account of concerns around unjustified deductions, low charges reimbursed, non-renewal of tariff rates, as well as one-sided blacklisting of hospitals. So given that development, going with the red for Star Health.
Okay, all right, got that. Thank you very much, Vamakshi. So let's quickly recap our list of stocks to watch this morning. The ones that have positive news flow around them: Hitachi Energy, HEG, Bharat Electronics, Anupam Rasayan, Navin Fluorine, Thermax, Syngene, and Ashoka Buildcon. The stocks that have some negative news around them are IndusInd Bank and Star Health. Okay, with that, let's get back to the global headlines and this big, whiplash that's playing out, the global sell-off. How is that impacting the world of, commodities? We have Manisha on the phone line. Manisha, it's been a bit of a sleepless night watching all of these events and these markets fall. What's the latest in your scheme of things?
Oh, well, absolutely, Surbhi. It's been a sell-off and a sharp one at that in commodities as well on tariff impact concerns. The global equity decline also has impacted commodities, so has the weak economic data. So if you look at the precious metals, they also have declined. So we have gold down 1% overnight, silver fell 1.5%. Crude prices fell almost 2% overnight on weak demand concerns there. And then we also are looking at Chinese producer and consumer prices declining more than what the markets were anticipating. For crude, it also is about increasing supplies from OPEC and allies, from Russia perhaps, and US for sure. And that is weighing on. And then it has spilled over into the metal space as well. Last week was a great one for metals, but this week hasn't started that way. So overnight, we've seen 1.5% decline for copper. Iron ore is now trading at a 2-month lows. Steel prices at 1-month lows, and that has had a spillover effect. Rubber is now trading at a 1-month lows as well. So most of the industrial commodities are really weighed down.
Thank you very much for that, Manisha, for that important update. We will get into a short break on that note. On the other side, we'll connect with Siddharth Khemka of Motilal Oswal Financial Services for some fundamental stock talk.
Welcome back. You're tuned in to Bazaar Morning Call. Well, let's get to some fundamental stock analysis. We have Sid Khemka of Motilal Oswal Financial Services who joins us on the show. Hi, Sid. Good morning and good to see you. Well, IndusInd Bank will be the stock of the morning on the downside because, the street was like, okay, with regard to the extension of their top boss just a year or so. But just a day after that, you're announcing accounting discrepancies in Forex derivatives portfolio, which could have an adverse impact of around 2.3% on your net worth. The street's not going to like this at all. What's your view on the stock? Valuation has some support, and it's been a big underperformer. I think if you put in, a couple of percentage points down today, that would make it in the last 1 month or so, the stock would be down easily close to around 17 to 18%. Your take?
Good morning, Nigel. Yes, I think IndusInd is the big one today. Very negative news flows back to back after yesterday's RBI's approval only for 1 year extension of the CEO, and now the discrepancy in the derivatives portfolio pertaining to transactions in the last 7 to 8 years, so FY24 and earlier. And we believe this could impact almost, you can say, 1580, 1600 crores of net worth. So what we have done is, we have downgraded the stock to neutral. We believe that this will not only impact the net worth, but also impact the growth in the coming quarters. With the board's focus on finding a new management, I think the entire energy would be driven there. And we are already seeing the Q4 being a weakest quarter in terms of the microfinance business. So I think it's definitely better to stay away from IndusInd for a few more quarters. I think whenever the announcement of the new management, that will instill some confidence to the market. Until then, I think the stock could remain subdued. Yes, stock has fallen down and valuations have come off, but with these kind of impact on financials, I think the valuation can take a further knock from here as well.
Hi, Siddharth. Today there is an upgrade coming in on Persistent where the target price is 40% higher than the current level. We're talking about CLSA upgrading Persistent to a high conviction outperform, and their target price is 9267. Now, Persistent, like all other IT companies, has corrected. It's down about 20-25% from its recent peak. In the IT pack, is there any stock that is attractive to you at these levels?
Yeah, good morning. So, if you look at the IT, I think they are reeling under the pressure of the US expected slowdown in the US economy, and that will continue for some time. Some of these stocks, which we like within the IT space, I think tier 2, the growth will be much better compared to tier 1, where the growth was about to recover. But again, with the talks of the US slowdown, I think the growth will be pushed back later. But if you look at tier 2, I think the tier 2 IT companies, the valuations were a bit high on back of the strong delivery. And two stocks particularly that we like is your Persistent, and the other one is Coforge, both of which we like, and we believe these are good levels to start accumulating. I think the pressure, especially in terms of sentiments, could remain weak for 1 or 2 more quarters until we see clarity in terms of the US tariff policy, the growth impact because of that. But I think the order books are pretty strong. Execution is pretty steady, and valuations look attractive given to the growth that they are liking. So we prefer Persistent and Coforge within the tier 2 IT pack.
Okay. Siddharth, hi. I just want to ask you a little about the chemical space because there's so much going on, a lot of different developments. Let me start with Thermax, first of all. Not that it's a chemicals company, but one of their subsidiaries is now, I think, going to build acrylic resins, getting into this tie-up with a Brazilian entity. What's your sense on Thermax, the core business, and then how do you view this development?
Yeah, I think yes. So if you look at the entire capital goods space, they have been under pressure because of the slower capex done by the government this year. And even if you look at Thermax, Q3 has been a challenging quarter with revenue up just about 8%, PAT declined 20%, impacted by the cost overruns and weak order inflow. So clearly, I think here the expectations for the coming quarters remains a bit muted. So we expect weak inflows, order inflows, as well as margins to remain under pressure. And even if you look forward for the next 2 years, the revenue CAGR is just about 12%, and with valuations such about 45, 50 times, I think the stock could remain under pressure for some time. So we definitely don't have a positive view on Thermax in the current environment.
Okay, that's Thermax. Now let me talk about more core chemical companies. There's so much going on. Navin Fluorine, they're, I think, commissioning some additional capacity. Yesterday, we were speaking to Vinati Organics. And Vinati, for instance, explained how, despite the fact that 20% of their revenue is exposed to the US, they didn't seem too concerned. So within chemicals, what all do you like at this point? Because it's very, very complex now. Anyway, these are globally linked businesses, supply chains, end markets. And now globally, God knows what's happening with tariffs. Who's selling what to whom?
So definitely, I think it's a bit tough to call out the policy given the flip-flop by the US government. But nonetheless, I think one sub-segment of the chemicals, which is the fluorine-based chemicals, I think that is looking pretty strong because of the improvement in demand. Fluorine, the prices in US specifically has risen, and that is leading to strong outlook for the fluorine-based companies, SRF and Navin Fluorine. Between the two, in terms of valuation, we are much more comfortable in SRF, where they are showing strong improvement in growth in margins, plus the demand recovery. And we see sequential growth in Q4 as well as in FY26 in terms of the exports for fluorochemicals, as well as improved margins. So the outlook for SRF, we are expecting a 20% revenue and almost 50% PAT CAGR for the next 2 years on back of the improvement in margins. And hence, we believe that is the stock to focus on within the chemical space. We have a buy rating and a target price of 3,500.
Okay, all right. Sid, I was looking through a couple of notes and trying to look at sectors which will not be impacted by any capital expenditure slowdown here in India, Trump's tariffs, China. And one sector that came on my radar is the hospitals. And Apollo Hospitals, in fact, the stock has seen a fair bit of a correction from the recent peak. And the Motilal Oswal note itself is talking about the EPS going up by more than 50% in the next 2 years. They have expansion coming on stream that could be potential value unlocking as well. What's your view on Apollo Hospitals?
Yeah, so I think, Nigel, if you look at that's the space which definitely looks insulated from the global turmoil. And we have seen last few quarters, the healthcare space reporting strong numbers, both in terms of the occupancy, plus some of these hospitals have improved or increased the bed count, both greenfield as well as brownfield. In the brownfield, we see the margins improving much better. So I think occupancy has improved for Apollo Hospitals in the recent quarters, and the 50% of bed expansion will be commercialized in FY26 and the balance little bit on FY27. So strong growth coming out there. We see steady improvement in occupancy, bed capacity, as well as enhanced offering under the healthco business. And we are expecting almost 20-22% net profit CAGR going forward. And valuations also look comfortable. We have a positive view buy rating on Apollo Hospitals and a target price of 7,800.
Okay, all right. Stay on so that we'll come back with some more questions in a bit. I'm just checking Asian markets once again. It's still red, obviously. The Hong Kong market and the Chinese markets are actually relatively the best of the lot. Yesterday, they fell a little more. But today, if you look at it, Hong Kong is, okay, now even the Hang Seng is down about 1%. It was down about 0.5% last I checked. So yes, overall, pressure on Asia. Quick break right now. Come back on the other side. We'll have our technical experts, Sudarshan Sukhani, as well as Mitesh Thakkar joining in. Welcome back. So let's now talk about technicals. We do know, there you go, 100 points. Gap down is what the implied open is indicating. Markets are seeing only one color, and that's red this morning. So how do you navigate a day like this? Let's ask our technical experts. Both Sudarshan and Mitesh are with us. Gentlemen, good morning. Mitesh, so just when we thought we can now, heave a sigh of relief, and there was green last week, we have fresh challenges this week. What should the approach be? What's the advice on the index, Nifty, Bank Nifty yesterday? Everything turned weak by the afternoon.
Good morning, sorry. So, this was always a pullback rally, and I was still hoping that we'll see higher levels. I was hoping that the gap of 22,750, 800 zone, I think, would be tested. But we kind of peaked out around 22,677 and then tapered off from there. Now, what is important is that the Nifty, if it remains below 22,500 odd levels, then good chance that we are looking at 22,300, and the gap down could suggest that we open about 100 points lower, which means that we might be only 60-70 points away from there. So that's the first support pivot, 22,300. But if we start breaking below that, good chance that we are looking at a retest of the closing lows which we got on the 4th of March, which is 22,080, 22,100 zone. So good chance that, because you failed on the upside, that in case you break 22,300, then the retest of earlier lows could happen.
Okay, all right, got that. Sudarshan, how are you feeling about the markets? Yesterday it seemed that the markets were sensing some kind of bad news, because in the last 90 minutes we fell off a cliff, and from trading in the green, we ended at the low point of the day. Today we're going to have another 100-point downtick. What do you do from there?
Yeah, good morning. See, now there are two possibilities. The first is that was an upswing, that was a bear market uptrend, and that has come to an end. The upswing we saw till yesterday afternoon. That's the first possibility. And the second is that after a big 700, 800-point rally, the markets will inevitably correct. Instead of correcting in 3 or 4 or 5 days, we have corrected in 2 days, and then we will resume. We'll find that out either today or tomorrow. What we need to do is convert these ideas into an actionable plan. Luckily, we can do that today. We have a support level of somewhere around 22,250. So far as that support holds and the market gives signs, okay, I've fallen, I'm willing to go higher, we can then consider buying with that stop loss. But that's a Lakshman Rekha. Anytime the Nifty is closing below 250, 22,250, we get out of long positions.
Okay, 22,250 is the important mark to watch out for if you're going long. Well, that's the mark you wanted to defend on the downside. Got that. Mitesh, let's come across to you. What about individual stocks?
Nigel, I have more of sell calls given the fact that yesterday some charts which were looking good have turned negative on the hourly and 2 hourly basis. So Angel 1 is the first sell call with a stop at 2076 for a target of 1980. Also a sell on Paytm with a stop at 682 for targets of 630. Buy on M&M on slightly lower levels, say around 2675.80. Buy with a stop at 2640 for targets of 2750, and Zomato is a sell with a stop at 216 for targets of 200.
Okay, all right, got that. Sudarshan, what about your stock-specific list?
Well, I have a buy list, and that's because, we are getting a gap down. Selling into a gap down is difficult in the best of times. And this could really be the point where the market says, okay, I have stopped falling. So we are looking at defensives. Nestle is a buy with a stop under 2202. Power Grid is a buy with a stop under 264. DMart, another, let's call it a defensive stock again, is a buy with a stop under 35.28. And Hind Unilever is a buy with a stop under 2201. So the idea is to look for safe havens if this market doesn't fall much.
Okay, all right. Thanks for that, Mitesh, as well as Sudarshan. Sudarshan, take care of that cough as well. It seems the throat is a little under pressure. Maybe some hot cup of tea will do the trick. Thanks a lot, guys. Well, let's take a short break. Come back, we'll get the pre-open rates. We'll also get chatting with Amit Dixit of ICICI Securities. He'll discuss the key trends in the metal space.
Welcome back. This is Open Exchange, and we're coming to you live from the CNBC-TV18 Motilal Oswal studio, still in conversation with Siddharth Khemka from Motilal Oswal. Siddharth, the big development last week is that the European Commission has announced a major defense initiative, which means more spending, more capex. And the question is, will it benefit any of the Indian defense companies? We'll be chatting more about this with an expert too, but give us your initial take and what the Motilal Oswal research throws out.
Definitely, I think, Rima, if you look at the entire world is going towards increasing the defense spend, including India, where they have to take care of themselves. And that is a positive because there will definitely be a lot of new alliances, Indian companies which are looking for technology, which are looking to increase their export base out of India. I think that becomes a very key attractive point, given that India is a neutral country, both for the Western world as well as some of these Asia-Pacific countries. And that bodes well. Some of the companies that we like within the defense space, BEL, HAL, Mazdondog, these are the preferred stocks. Even if you look at from a domestic standpoint, FY25, we saw a slower order book inflows for a lot of companies, which impacted the sentiments. But now the government is looking to meet its FY25 guidance. And over the next few days, we'll see a flurry of order going out, and that will improve the sentiment because that will give you the visibility. If you look at BEL, they've just secured a 843 crore order. So overall, the accumulated orders for FY25 now stood at 14,500 crores. We believe BEL will be a key beneficiary of the defense electronics opportunity across large platforms, be it Navy, Defense, Air Force. Valuations for some of them are attractive compared to some of the smaller names where the valuations have reached up 60, 70 times. So if you look at BEL, Mazdon, they trade in the range of 30, 35 times PE with an earnings growth potential of 40 to 50% over the next few years.
BEL is also in focus today on the back of order wins. As Upasana was earlier telling us, they've received orders worth 843 crores since 6th of March. With this, the total cumulative orders for FY25 stand about 14,500 crore, but it still falls short of the FY25 order inflow guidance of 25,000 crore rupees. So if they have to meet that, they need another 10,000 crore more.
Absolutely. Sid, I wanted to ask you about a couple of these insurance companies as well. Yesterday, the NCLT has approved the reverse merger of Shriram Life Insurance with Shriram Life Investment. This could be a positive read-through for Max Financial because Max Life could get merged into Max Financial. There could obviously be appeals, but at least that NCLAT, green signal for the Shriram Group could be a positive read-through for Maxfin. Your take on the stock?
Yeah, I think the merger will definitely help through because it will improve the holding structure plus increase the cross-selling opportunities for the Shriram Group and eventually for Max. But if you look at within the insurance space, Max, I think they have been looking at a weaker set of numbers. Even Q3, the VNB margins declined 400 basis points impacted by the higher ULIP share as well as the surrender charges. Even the shareholders' PAT dropped 54%. So I think the Axis Group merger, that should boost penetration. And despite that, I think the valuation looks a little bit on the higher side. Within the insurance space, I think some of the other ones, we recently upgraded HDFC Life from a neutral to buy. We see improved growth, margins seeing a good recovery. And for FY26, we see almost a 30% net profit growth for HDFC Life. The stock has been consolidating for a very long time, leading to a time correction in valuations, which we believe now looks attractive along with the improvement in growth. So within the insurance space, we would prefer an HDFC Life where we have a buy rating and a target price of 800.
Okay, all right. Thanks a lot, Sid. Always good to have a chat in the morning. Wishing you a good session ahead. It appears to be a bit of a tricky one, but we look forward to chatting up with you in the next few days. That said, let's focus on the metal space. Economic downturn across the globe, it could impact commodity prices, including metals. Trump has also announced 25% tariff on steel as well as aluminium, while China, well, they plan to restructure its steel industry. India's also has plans with regard to safeguard duty on steel imports. So what's the outlook looking like? We have Amit Dixit, the analyst at ICICI Securities, who joins in on the show. Hi, Amit. Good morning. And I'm just looking through your note that you put out this morning. On ferrous, you're seeming positive. The problem is, though, that there is plenty of uncertainty. So does this positive stance factor in Trump's tariff or what he's announced so far? And also, if the US economy could slow down, that could put this positive stance into question, right?
Yeah, hi.
Amit? Yeah.
Yeah, hi, good morning. So thanks for having me on the show. Our positive stance on the sector is due to two factors. There is first of all local factors. The local factors being that the consumption growth, if you look at the month of January, it has improved to 10.4% from 7% and 4% respectively in the month of December and November. So clearly, we see that consumption growth remains robust in the country. The second point is on imports. So imports have actually come off successively due to the apprehension of safeguard duty coming in at any point in time. So once the safeguard duty investigations started in December, we have seen that imports and the tendency to book imports by the traders has come down. Thirdly, if you look at the steel prices, so from being very static in the month of January, we have found that in March, actually, people have taken a hike of roughly 1,500 rupees a ton. And my own channel checks indicate that the quantum of increase could be to the tune of 2,000 rupees until now. So clearly, spreads are improving, profitability is likely to improve. And as far as the macros are concerned, see, one can't lose the sight of significance of this announcement by NDRC. This is for the first time in 5 years, NDRC documents talk about anything about production cuts. There has been mention of stable production, but never of production cut. In fact, it's a decadal thing, I would say. The last time we heard of production cuts in China was in 2016, when coincidentally, in macros we were grappling with the similar aspect that that booming exports of China are slowing growth everywhere. Now, as far as the tariffs are concerned, well, these are known to be detrimental to the sector. However, if India institutionalizes safeguard duty to prevent imports, I would say that this would be a very positive step. As I understand, 90 days have elapsed since the investigation have started. So we could hear about the decision anytime soon. And I think that would be the positive thing for the sector. Steel, do remember that it's a very local commodity. It is becoming a very local commodity in light of the localized prices, the tariffs by all the countries on each other. So it has to be seen in this way. As long as our consumption growth remains robust, and that is the stark change from the last time, that we are in the fourth year of a double-digit consumption growth. I think you can't bar that off. So despite the overall, risk factors, I believe that steel would perform relatively better compared to non-ferrous in such a scenario.
All right, Amit, if there is a safeguard duty, what is the number you're working with? And since the domestic steel is as it is at a premium in comparison to imported steel, what is the headroom you'll see on pricing? Or is it more in terms of operating leverage that will play out in favor of the ferrous names?
So in my view, it would be the later, because the thing is that already we were running neck to neck with the landed price of imports, but the price hike in the month of March has put it at a slight premium of roughly 4%. By 4% is not something that one should lose the sleep over, because generally, historically, we have seen that domestic prices have remained at a premium of 5% compared to the landed price of imports. Nevertheless, I think that the safeguard duty will not be an opportunity for people to increase prices. In fact, what I see that imports, which were quite high to the tune of around 0.7 to 1 million tons every month, are likely to come down. And that would actually give headroom, give space for domestic players to expand their volumes. And there are two domestic players who actually have the capacities ready, JSW Steel and Tata Steel. I think they will be relatively better than the others.
Okay, all right. And your top picks come up for our viewers on the screen as well. Thanks a lot, Amit. You're sounding confident with regard to the Fed's space. Consumption growth is good. Imports are slowing down. And if there is a kicker with regard to safeguard duty as well, that'll bode well as well. Thanks a lot for joining in. But it's 9:10, so let's get to Sudarshan, who's back with us to give us his 9:10 call. Sudarshan?
Well, consider buying Nestle with a stop under 2200.
Sudarshan, thanks a lot for giving us that call. Mitesh, what about you?
I look at a sell call on Angel One for targets of 1980.
Okay, all right. Got it, Mitesh. Thanks very much for that. Mitesh, actually, before we let you go, I just want to revisit the levels very quickly on IndusInd Bank. Look at the stock. Pre-open, it's down 10%. The market's really disappointed. Beyond the impact, which is 2.3% of net worth, and you can do the math around that, the sequence of events.
Yes.
Three-year extension asked, 1 year extension given by the regulator. Same day evening, you finally get this disclosure that there is an accounting discrepancy. I mean, it is 2.3% of... So the sequence of events the market just doesn't like. Let's get Abhishek on this and then quick technical check, Mitesh. If you could just stay back and just give us the levels on IndusInd. Abhishek, but you go first.
Internal review process with respect to asset and other liability accounts of derivative portfolio. Over there, IndusInd has disclosed to exchanges that 2.35% of net worth will get adversely impacted, which is roughly around 1,580 crore post-tax or about 2,100 crore pre-tax. So they have appointed an external agency to review and validate the internal findings. The bank's profitability and CRAR, that is capital adequacy ratio, remains healthy to absorb this one-time impact. Now, management in con call did say that the practice has been ongoing for 5 to 7 years and was discovered as part of review initiated following new RBI guidelines effective 1st of April 2024. So, CEO's 1 year extension versus 3 years that was sought by the board of the bank acknowledged to be influenced by this issue. So, analysts do say that there is one-time earnings impact, but this can lead to short-term or near-term de-rating of the lender. So they have cut earning estimate anywhere between 20% to 25%. We have brokerages like MK, Jeffries as well as Citi who have cut the target price on the stock. In fact, MK has downgraded the stock to add from buy recommendation that they had earlier. Back to you.
Thank you very much for that. Indeed, the timing of the disclosure is what's rattled the investors. Mitesh, a quick word. The stock is hitting fresh 52-week lows every day. So where does support lie for IndusInd Bank, and is there any trade?
Yeah, I don't think will happen because you'll be opening gap down with the circuit. But the support levels come around 775, 770 zone, which is where the stock had bottomed out in June of 22. I think that's a pivot which could help, but otherwise the structure is weak. Eventually, I suspect that it might go further lower than these levels as well.
And just one more technical point on IndusInd Bank. Promoter entity holds around 16% and 50% of that is pledged, and that pledge has been taking place over the last few months or so. So that's going to be another important part, with regard to the promoter pledge on their holding. But let's hop across to Sudarshan. He's here to tell us about Adani Ports. Sud?
So Macquarie has initiated coverage on Adani Ports with an outperform call, and target by Macquarie is 1,500 per share. Remember that stock has recovered or gained nearly 10% from recent lows. So what does Macquarie say? It says company is well positioned to capitalize on India's long-term growth potential, and it's a diversified port and cargo mix that supports the resilience and integrated nature of logistics offering should aid further customer lock-in, and visibility of healthy recurring operating cash flow remains high for Adani Ports. Also, YTD, that company has reported cargo volume of 409 million tons versus FY25 guidance that company had given. It was in the range of 460 to 480 million tons. So on cargo volumes, still it remains around 70 million tons below the FY25 guidance, but Macquarie remains positive on the stock.
All right, so Sudarshan, thank you very much for that. Adani Ports will also be on our radar. We'll kickstart with what the implied open was indicating, this 100-point gap down. The question is, what happens after that? Will this market have the appetite for some recovery, given that we've already, we were way ahead of the fall? Our markets, our indices are down anywhere between 15% to 25%. The US has started faltering only now. So that's the question. But yes, we have the current challenges to navigate, which are, of course, all these tariff concerns and the US concerns. So it's an across-the-board sort of a gap down that we're starting off with. It's not any particular sector. Mid-cap index is also all set for a lower start by almost 1% lower. The bigger question is, of course, what after the gap down, and if there can be any leaders emerging. Will banks come to the rescue? Can Reliance come to the rescue? Let's find out. Okay, off we go. 122 down, 130 down on the Nifty, which is a cut of about 0.6%. IndusInd Bank straight away down 10%. It's locked at that 10% freeze right now, not moving at all. So let's see, what transpires. Absolute lock at 10% on IndusInd Bank. It's not recovering. Anyway, let's look at what else is weak. Technology is, of course, the NASDAQ, wins have hit us as well. Infosys, Wipro, HCL Tech Mahindra, TCS, all standing in a line, or falling in a line, I should say. Trent is weak, JSW Steel is weak, Tata Consumers, Bajaj Finance. It's a wide sea of red. Let me actually look for any of the moves on the upside. And ICICI Bank is finding some takers. So it's a very, very strict flight to quality kind of a morning. Very little green on Maruti. Beyond that, I can't count much at this point in time. Some little trickle of green on Bharti Airtel. But aside of that, everything is down. The large caps are trying to fight back. Keep your eyes on L&T, ITC, Lever. And let me also pull up Reliance. Reliance is still down. So these big boys are very close to the even-Steven line. Let's see if they manage to make it. But right now, no doubt about it, it's a down morning. The Nifty is down 130 points. Mid-cap index is sliding even more, about 1% lower. And the Bank Nifty is down 0.5%.
On the Nifty, Sudarshan had given us the level, 22,250. That's the important mark you need to track on the downside if you're going to be adventurous and go in there and buy the Nifty. That's important. The Nifty Bank, though, after moving to around that 47,800 odd mark, which it's done numerous times in the last 7 to 8 trading sessions and bounced up there, it's seen some kind of buying at that level. So 47,750 to 47,800. The Reliance, that's the one that will need to perform. As of now, it's holding above its 20 DMA. The 20 DMA is at around 1,216 rupees. So we're still a little 1.5% away from those levels. That one will have to put in a good fight and support the Nifty Bank, because for the time being, you have the tech stocks that are getting it on the chin. Let's pull up a few names. You have HEG. There was some positive news flow overnight with regard to value unlocking in one of their subsidiaries. HEG, the stock is still down close to 100%. So the street for the time being is ignoring any kind of good news. The other one was BEL. They won an order as well. So that as well should come up for you on the screen. Let's pull up Max Financial, because of the NCLT verdict that came in favor of Shriram. The sheet sees this as maybe, in fact, it could be the green signal for Max Life to merge into Max Financial as well. So that could be one of the reasons that stock is outperforming in today's trading session. There could be various challenges, but that's one of the few stocks in the green. The breadth of the market, that's worrying. We're back down to around only 250 stocks that are advancing. You'll want that number to gradually, improve by year on. But par for the course, I would say. 100 points yesterday down. Today, another 100 points down. Maybe some part of this overnight weakness has got factored in, at least for now, with this 250-point cut.
Well, it's a full risk-off screen right now. That advanced decline ratio, 1:7, tells you the picture. On the way down, Jyoti CNC. Now, this one's been an outperformer. It's up 15% in the month of March. Since the start of the year, the stock has also been higher. 47% gain in the last 1 year. But today, the stock is seeing some amount of profit booking. International Gemological Institute, IGI, the numbers were disappointing, and this stock is down 45% since the beginning of the year, 4% lower today. Across the board, railway stocks are getting hit. So there is a slump on Railtel, Ircon, RVNL, IRFC. Across the board, cuts range between about 3 to 4%. Bandhan Bank is weak in trade. RBL Bank, so select banking names are down in trade. By the way, now the mid-cap index is trying to trim its losses, at least at the headline level. The mid-cap index opened with a cut of 1%. Now it's down close to about 0.5%. The advanced decline ratio is still weak, but at the headline level, some of those losses are getting trimmed. On the way up, you've got a few stocks in the green, and they're moving up on pretty decent volume. So Laurus Laboratories is topping the pricing in the volume chart. That's up nearly 2%. Kolte Patil, Paytm is a stock opening up in the green. Zomato, very close to the 200 rupee mark on Zomato. The opening should come up for you. NTPC Green, Adani Wilmar, Anupam Rasayan, where there is that LOI. So that's managed a positive start. And oil marketing companies, IOC, BPCL, also managing a green tick in the morning. So down. Question is it out or not?
I guess very early. It's very, very early in the day. Let's see. I mean, this pitch is turning. Let's figure out how it goes. The large caps are not seeing any reprieve just as quickly. And what we've seen yesterday is, I think this is a market where you can't jump too quickly. Things change at the drop of a hat. That's what happened. We were cruising along quite nicely yesterday till about 12:31, and then things suddenly turned. So it is still a fragile market. Sentiment is still fragile. Yet there are bargain hunters which are sort of venturing out there. So let's just wait on it and see how this transpires.
Today actually will be a good trading session if the Nifty wants to show that it's going to outperform from here on. Maybe we do better than 150 points down by the time we wind up. And we do better than in the broader markets. You see only 250, 260 stocks advancing. So by the end of today, you'll want the losses to be less than 150 points on the Nifty, and you'll want the number of stocks advancing to be far higher than what we're seeing right now, because Bavast is underperformed. We have a couple of tailwinds with regard to the domestic tailwinds, the government spends, the RBI, they've injected liquidity, and also the global tailwinds with the softer dollar as well as, softer crude oil prices. So today is the perfect day if we have to prove that.
No, absolutely. And for me, even if it's a down day, if India starts outperforming, even if global markets are falling, if we fall less, that's perhaps saying something after a long time. But let's take this discussion forward with Dheeraj Agarwal, MD at Ambit Investment Managers. Dheeraj, great to have you with us. And, this is a good morning to have you on as well, because there's so many moving parts, right? Just when we were heaving a sigh of relief, last week was a good week, we stopped falling. Now we have this fresh salvo from the US. And, this is where it's interesting and slightly confusing. We were sort of complaining about US exceptionalism all of these months, and that was the problem, right? The home trade became too good. Now the home trade is faltering. But will it necessarily mean good things for India?
I know there's we want to be hopeful, but I think I maintain the same stance which I have on the channel last couple of times, that I think 25 is going to be a tough year, perhaps 26 also. And it's got nothing to do with the US. US up and down will impact us mostly at the open trade. I mean, last few times US has fallen 1.5%, 2%. We have seen a gap down open of 0.5% to 0.75%, and the closing has been very, very different. So I won't worry too much about whether US is going up or down, but I worry about the fact that earnings growth in our market has slowed down. I don't see any meaningful signs of a pickup going forward. I'm expecting, I think FY26 earnings growth consensus numbers of 12% or 13% for Nifty will disappoint. It will be perhaps below 10. A lot of damage has already been done, so perhaps not too much of incremental damage from here or too much of incremental deep damage from here, but a very dispersed stock price movements, very polarized stock price movements is around the corner, where stock picking and making money is not easy. So I continue to hold that prognosis for the time being. And if US actually goes into a recession, as some people are fearing, it's usually not good news for India.
Dheeraj, you rephrased yourself very quickly. Incremental damage, yes, but not incremental deep damage. So you're worried about earnings slowdown and the possibility that even FY26 could be a high single digit or a single digit kind of an earnings picture. Are you worried about domestic inflow slowing down? There was data which came out yesterday how demat accounts in the month of February have hit a 21-month low. Zerodha has flagged off how volumes after the F&O regulations are down 15-20%. Tomorrow's Amphi data will be the litmus test. But what is the anecdotal evidence that so far it's been the DII, the retail investors, who've held for, they provided that support. But is there some faltering, flagging off of weakening momentum?
It's possible. I mean, you talk about what is historical data, right? What does the historical data say? That's the best benchmark we can use because it's impossible to predict flows. And if you look at, in fact, our strategy team at Ambit Research, Bharat and team have done this job, have presented a very interesting chart in the previous note, that whenever 12-month returns from the market turn negative, DI flows tend to weaken a little bit. And we are almost there. I think 12-month return is just 1 or 2%. In another month or two, the 12-month return will start looking like a decline or a cut. And that usually impacts the DI flows. Now, I'm not a bear on DI flows. I think structurally, Indian households are still underinvested in equities, and it's a very, very structural, multi-year, multi-decade move. But can the roughly 50,000 crores a month kind of a run rate that we are seeing at this point of time, can it drop down by 20, 25, 30% for a few months? You can't rule that out. I mean, that risk is always there.
Got that. You said it can't be good news in any fashion if the US markets enter into a period of slowdown or a recession or things, reach, I mean, it gets bad over there. So what happens? Suppose, are you expecting a US recession? If the froth in the US comes off, how do you expect India to perform in such a scenario?
So, I mean, whether the US goes into a recession or not, at this point in time, the jury is still out. I mean, frankly, I am not in the recession camp. I'm more in a slowdown camp, slowdown and consolidation camp. I'm not in a recession camp. So a slowdown is okay for India. It's neither here nor there. I think we can trudge along if the US economy slows down. But last 30, 35 years that I've been watching the markets, all US recessions have hurt India as well. But I don't think there will be a recession. I think more likely a slowdown. From an Indian standpoint, I mean, there are two things to watch. One is, as I already mentioned, earnings growth slowdown. Second, more important than US at this point of time is China and Europe. Just remember, a year ago or 6 months ago, people came on the channel and said, where else will investors go? Europe is looking like a museum. China is looking like a graveyard. India is the only growth story in town. Now suddenly people have options. So Europe is no longer looking like a museum. The new German chancellor is promising to break the fisc and go in for a full-blown reflation. Other European countries are likely to follow. China is at the margin, stabilize their property market. Their tech aid is growing well and challenging the Magnificent Seven in the US, and looking like a investment destination worth considering, at least. I mean, if not very attractive, jury is out again, but worth considering. And suddenly India has alternatives, and there are other alternatives in the world as compared to India. So these headwinds are likely to continue for some more time. And we will perhaps be a choppy, volatile market through 25 and most of 26.
Hi, Dheeraj. You're sounding very, very cautious this morning, but there's clearly some part of the market that you'll be positive on, right? It's going to be a difficult year. We get that. I think the good news from an India investor perspective is that we have underperformed. So part of the bad news is in the price. Last year was very, very slow on the capex expenditure front, which will only get better in FY26. And the hope is, that earnings will improve. And ultimately, earnings is the most important driver for the markets. There's still a couple of pockets as well which are overvalued. But you would be positive on a couple of themes, right? If you could help us out with that.
So actually, I believe this will be a themeless market, right? So whenever markets go into polarization phase, and polarization simply means that a smaller percentage of stocks will do well and a larger percentage will perhaps struggle or underperform. Whenever we go into a polarization phase, one of the two things happen. Either there are one or two sectors which shine. So like in 2018 to 20 polarization phase, FMCG and a few private banks just outshone everybody else. But if you remember the 2011 to 13 polarization phase, it was very, very stock specific. So I'm actually of the view that we will see a 11 to 13 kind of a phase, where in every sector you'll find winners and losers. So the dispersion within a sector is likely to be very, very high. I mean, if we just look at the last 5 or 6 months as an example, when IT stocks in general have been under pressure, Coforge has delivered 8 to 10% positive returns. And similarly, in many other sectors, you'll find the top performers are either flat or marginally positive, whereas the bottom performers are down 30%. And that's what is more likely to happen, more than the themes. So how do you pick those? One is earnings growth, but more important, predictability of earnings. But the factor which I think will be most important in the market in 25 and 26 will be valuations. So even if earnings growth are coming through, but if the valuations are very steep, one needs to be careful.
Well, those valuations, Dheeraj, just to complete that point, and then I actually want to ask you about something else which is bothering the market today. But just to complete that point in valuation, 15% down at headline index level, 25, 22% down in small caps, mid caps down 20%. Haven't those valuations now corrected to levels which are palatable? I mean, the Indian market's never been cheap in any case, right? So you still find them a little overbearing valuations?
I think so. I believe in market cycles. In fact, I call my investment framework sine curve. And the essential factor or essential feature of the sine curve is that if this is a line of best fit, let's say this is a line of fair valuation, since we're discussing valuations. Valuations will always move 2 to 3 sigma above mean and 1 to 2 sigma below mean. We are approaching the mean at this point of time, and that too only in nifty. We're not even at the mean for mid and small. But whenever cycles turn, you're likely to see it fall below the mean by 1 sigma or 2 sigma, at least 1 sigma. So the short answer is we're not there yet.
Not there yet. Okay, let me talk about the other issue and, kind of humorous on this one. IndusInd Bank. Now, I'm not asking you for a stock call at all, but I'm just asking you for the events as they've unfolded for a large cap stock. I mean, we're talking about a big nifty stock here. And the way the market's reacted. Anyway, the market doesn't have any appetite left for, uncertainty, confusion, or nasty surprises. But what do you think is happening here or has happened here with the management extension being shorter than what was anticipated and now this whole derivative issue? How are you looking at the ongoing developments? I don't know if your team covers the stock, I mean, at a research level at all, but this is a bigger question beyond buy or sell.
No, I have no specific comments on IndusInd Bank, but I think you rightly captured it by saying markets at this point of time has no appetite for negative news at all. So it's just the reverse of what was happening till 6 months prior. Negative news would result in a 1 to 2% cut. Positive news would result in a 5 to 15% upward move. And now it's become the opposite. Positive news results in 1 to 2% upward move. I mean, look at BL, for example. You mentioned on the commentary just before I joined that they received another order yesterday. Stock is up 0.5%. But look at IndusInd Bank is down 15. So that's purely what the sentiment of the market at this point of time. In fact, I have a very interesting theory that if you actually pick up a newspaper on a daily basis and with a very unbiased form, divide all the news in positives and negatives, for most days of the year, it's 50-50. But when the sentiment is running positive, the positive news is on the page 1, the negative is on page 10. When the sentiment is running negative, negative news is on page 1 and the positive is on page 10. And that's what drives the market.
You know, it's really telling a story today in IndusInd Bank. This is not about the actual numerical impact that's going to play out in earnings. It's a much bigger issue than that. The freeze opened 10%. The moment it opened, next 15%. That's where IndusInd Bank is today. And by the way, on that analyst call, just to sort of jog our viewers' memory, let's pull up IndusInd Bank if we can. 10% has gone to 15% straight away, drop of a hat. Can we get the stock up on the screen? There we go. That's what we're talking about. That's the next freeze now. It's obviously an F&O stock. So that flex happens and then it opens and then again 15%. Yesterday, when the analysts asked the management that the fact that Mr. Katpalia got a 1-year extension and not a 3-year extension, does this derivative issue have anything to do with it? He said, and I quote, that this would have had a bearing as that is the RBI, they were aware of the issue. But I don't know what the rationale is to give me a 1-year extension, but I think they're not comfortable with my leadership skills of running the bank. So it was from the horse's mouth. Mark is just very, very nervous. Anyway, all right, we live in choppy waters and slightly uncertain times. Thank you very much, Dheeraj, for joining in. I really appreciate you being with us on the show this morning. So that's a call from our market master. Looking at the market, still down about 0.5% right now.
So let's get chatting and focus zero in on the EMS space. Now, it's been a big wealth creator. Dixon listed, for the last 5 years, Dixon's revenue growth has been about 40 to 45%. Kaynes has had a shorter listing history. It listed only in 2022, but in the last 3 years, Kaynes' revenue growth was about 62% CAGR and the profit growth was about 165%. What does the future hold? Investec recently turned positive on EMS stocks. They're convinced about the growth opportunity in the sector. They upgraded Kaynes Tech and Syrma SGS. They also prefer Dixon Tech and Amber Enterprises. So to discuss this sector in detail, we'll connect with Saurabh Gupta, CFO of Dixon Technologies, and Jairam Sampath, whole-time director, CFO of Kaynes Technology, on the show now. Thank you very much, gentlemen, for joining in. That's the first question, right? The kind of exceptional growth that we've seen in the past for this sector, can it continue over the next 3 to 5 years? And I want both of you to weigh in. So, Saurabh, you start first. I was just checking. Your 5-year revenue and profit CAGR was 40 to 45%. Your ROEs were about 23, 24, 25%. Now, considering that you have expansion plans, you're adding capacity, you're looking at display fab manufacturing for the next 3 years at least, do you think you can sustain this 40-45% kind of revenue profit growth and maintain your ROEs?
Yeah, good morning. Thank you for having me. So we feel confident that kind of opportunity that we are sitting on, both for the domestic market and now increasingly for the global markets as well. I think so there is no reason why we can't grow by 35 to 40% annually for the next 3 years with more focus on backward integration. So I feel that that will add more strength and moat, and that should also lead to the margin expansion that what we are doing right now. So yeah, 35 to 40% of the growth is definitely doable for the next 3 to 4 years.
And ROEs, can you build on the ROEs from current levels, or do you think the expansion could hurt?
My sense is we have grown from 2,000 odd crores to 39,000 crores hopefully this financial year, and we have not compromised on the ROCs and ROEs. In fact, those have only gotten better. So like last quarter reported ROC for us was almost 42%, and the initial years we were at 30% kind of ROC. We think that those ROCs and ROEs profile should be maintained. There should be significant cash flow generation, because the businesses where the largest growth for us is happening is basically mobiles and maybe IT hardware going forward. So all these businesses are high on asset turns, and once you focus more on the backward integration, those again will have a positive impact on my ROCs and ROEs.
Jairam, you come in on the next 3-year picture. Now you're setting up capacities in PCB, OSAT over the next 2 to 3 years. So that's going to be the incremental revenue driver. What kind of a revenue growth are you confident about for the next 3 years, given the visibility and the plans that you have, and throw in your expectation on how margins and the return ratios move?
Yeah, so thank you for having me on the show. I think these questions have been something that we've been battling with ourselves. See, fundamentally, the EMS sector, or ESDM sector, as we would like to call it, is good for maybe around 40 to 50% CAGR without any dilution of our EBITDA numbers. Of course, we need to improve our ROC a tad by improvement of working capital, net working capital, which perhaps will happen with the scale too. Now, the additional sectors that we have forayed into, like the semiconductor assembly and the PC board, is going to be value accretive. And so by maybe about 2-3 years time frame, they will also start weighing in with their revenues and profitabilities, etc. So I think we should be able to see about 40 to 50% CAGR on revenues for sure, without any dilution of margins. And hopefully we would probably also improve the performance of our working capital management so that the ROCs, etc., can be maintained. It's important to say that one thing is to enjoy the tailwind that's already available. The other thing is to also prepare for the future, because we are now looking at beyond FY28. 28 is when we said we'll get to $1 billion. It's a big number for us, and maybe beyond that, no, we are acutely aware of the fact that within a couple of years, again, it has to get into a higher number. So we are also looking at other beachheads, so to say, to bolster this market. So currently, it's obviously domestic driven with a lot of tailwinds and government's stated position of Atmanirbhar Bharat and all that. But over time, I think all of these things are bound to see some corrections. And so we are preparing for a future wherein the geopolitical, let's say, items also come into the agenda, and then we don't want to be taken by surprise. So we are also looking at other beachheads and so on, so that we can maintain this growth of 50% plus CAGR over next 10-year time frame.
Okay, all right, Mr. Jairam, welcome to the show, and Saurabh, welcome to the show as well. Mr. Jairam, let me come across to you first. The longer-term story seems to be intact, but tell us, how do you see ordering activity in Q4 so far? And also, if you could tell us about the ordering activity for smart meters. Give us a sense about it. Is it good enough? Is it up to expectations? Has there been some slowdown? Ordering activity, I want to get a sense of pulse on ground.
Yeah, sure. So let me take the second one, the smart meter bit. I think what we see is an acceleration. So this year we might end up with a very good fourth quarter thanks to these smart meters. And next year we'll probably double the number of smart meters that we deliver. So from the perspective of order inflow, that's always been increasing, and the order inflow has been increasing at almost 25 to 30% per quarter on a quarterly basis. So you multiply that by 4. So it's a pretty strong input of orders. And this is after, not really getting the kind of orders that we actually were expecting in some of the sectors that we are very strong in. So I think FY26 story will be probably even better than FY25. So we can see in some sense, we've seen the bottoming out of the, let's say, the growth story. And then I think it's there to pick up. Lots of good things have happened, not just in our ESDM market, but also in our semiconductor and PC board also. The nearer we get to it, we certainly realize that we should have probably done it earlier. So I think the order inflow, business outlook, all that is extremely good, and it is probably better than what we expected.
What on the PCB project, what is the incentive amount that you're factoring in? And if you could tell us, when does that project go on stream as well?
Yeah, that project goes on stream we'll start getting significant revenue the fourth quarter of coming year, FY26. And we get about 60% total capital subsidies. We don't talk too much about PLIs, etc., because PLIs are visible things, and we don't give much reliance to PLIs. But certainly, capital subsidy is something which helps us to get off the ground very quickly.
Okay. Since we're on company-specific issues, let me just wind that up before I talk about the other global issues. Mr. Sampath, so this delayed orders, I mean, Q3 was impacted by this 100 crore delay, which was supposed to be pushed over in Q4. Are you on track with that? And I think at the end of the third quarter, you said that the year should end between 2,800 to 3,000. Are you still within that ballpark for the revenue?
Yeah, we'll certainly cross 2,800 and we'll do the EBITDA of 15%. We are hardly a few weeks away from the end of the year, so I think that is on track. And coming year, certainly we are a little more careful. Most of the delivery-related issues have been ironed out, and now most of the factories are firing on all cylinders. So hopefully next year will be a little easier. And
and just very quickly, okay, got that. So this year you should be within the ballpark of 3,000, which was your earlier guidance. Got that. And just very quickly, Mr. Sampath, there was some talk of you looking at equity fundraising as well. There was a talk of a 1,600 crore rupee fundraise because you wanted to acquire maybe entities overseas. Where are you on that?
Yeah, so we continue with our actions. So only thing is the fundraise probably got deferred by a couple of months. We thought we'll get the year behind us before we got the approval from the shareholders. So we'll be launching sometime in the coming fiscal. When the time is right and the opportunity window is there. At the same time, we are not diluting on our activities, and we do have a three-pronged strategy. One is geography expansion. The other is getting better strength into the ODM area, and also deepening technology footprint. Because we do realize that all these tailwinds of demand, which is crafted by, let's say, either by tariff barriers or by any other localized demand factors, over time will get equalized, and then we need to be a technology leader. So that's what we are preparing for. This is not required for our $1 billion target, but it's required for doing something beyond 1 billion come FY28.
So basically that fundraise has been pushed by maybe a couple of months. Got that. Now let me come to Saurabh. And now the bigger question that we wanted some understanding on. I was looking at a note that's come in just yesterday. It's a Nomura note, because everybody's trying to wrap their head around the numbers on this whole tariff business, right? So we are obviously importing a lot of the components, and duties. India's duties on components have been going down in line with the government's Make in India push, right? All of you have been sort of asking for it, and the government has been doing that. According to these estimates, these are Nomura estimates, our overall electronics exports to the US have grown big time. I mean, they were at 2.5% in FY20, and they're at $11 billion in FY24. So now, if reciprocal tariffs kick in, what happens to the EMS story with respect to the US market? If you could give us some ballpark sense on that, and whether it impacts you in any way. I mean, over the weekend, we had Mr. Howard Lutnick. He was all guns blazing, saying, make those, Apple phones in US. Why should they be made in China? He didn't take India's name, but we know those phones are being made in India as well, right? And he was saying that even if the wages are higher, get robots to make them, but make them in America. So with this kind of a mindset, Saurabh, if you could take this up, I mean, isn't this is straight worry for your business?
Yeah, so let me share you my perspective. Of course, yeah, so this is an ongoing thing. The negotiations are going on, as you mentioned. The broad counters are still not out. There has been more still in the discussion phase. But let me give you my perspective. One, of course, India's export to US is $11 billion, and this number will, of course, go up in FY25 as well. But it is still much lower than what China exports. So China's exports, so India's share of electronic exports to US is just 2 to 3%. China is broadly at around 35%. Mexico is somewhere around 22%. So clearly they're very higher as far as the US imports of electronic products are concerned. Now on both the countries, the tariffs have been implemented, and to the extent of almost 20%, which was negligible or nothing in the past years. So we feel that India is at a competitive advantage. So overall, we feel that it will be beneficial for India, because if you look at the overall import duty of on any finished product of mobile phones, it's still 15%. And on wearables, it's around, say, 20% odd. But if you look at the overall components as well, components are slightly lower. So the weighted average tariff is still 3 to 4% for electronic products, which is still very low. So now, assuming the Trump is talking about reciprocal tariffs, so either you can put the same tariff on the same product, or you can put a weighted average tariff across a basket of commodities. Now, the basket can be on export and import can be different. So according to that, if that comes into the system, we are talking about 3 to 4% tariffs, which is very low. Now, as far as your question on the manufacturing in US is concerned, we feel that is slightly difficult. Of course, anything can happen, but we feel one, because of the low value addition of the product. Secondly, the wage rate differential disparity between both the countries. So US is almost 10 times more expensive. So we are talking about $1.5 an hour versus $15 in US. Third, the US dollar is strengthening, making the manufacturing more expensive. So we feel that seeing in light of all these factors, India is slightly in a better position. But of course, these things also, we are living in a dynamic world. So this tariffs needs to be sustained on China and Mexico for the supply chain to shift.
No, Saurabh, sorry, just trying to come in to understand right now, what is Dixon's exposure to the US, if at all? Total revenue, what is the export element to the US, if at all? And then if Mr. Sampath could tell us the same. Saurabh?
So for us, it's a very small number. Last year, it was out of, it will be broadly 5% of my revenues, mainly for my anchor customer. But the same anchor customer is now talking to us for larger export quantities to US in light of the tariffs which have already been levied to our neighboring country, on our neighboring country.
And you don't think that's at risk? Will that anchor customer, US anchor customer, continue to look at sourcing large volumes given, you know, the sort of the rhetoric and the reality in the US on tariffs?
So my sense is we feel that we will be at a competitive advantage as compared to China, even after this reciprocal tariffs come into the system, which will not have much of impact as what we think. As far as electronic products are concerned and smartphones are concerned.
Saurabh, Jairam, great conversation. More to ask, but we're out of time. But thank you very much for joining in on this discussion on tariffs, the long-term picture, the near-term, and so much more. Get into a break. On the other side, we'll connect with Nazara Tech Management as it's divested nearly 95% of its stake in Open Play Technologies. Welcome back. As promised, let's invite the management of Nazara Tech. The company has completed the open play sale for nearly 104 crore rupees to Pokerbazi's parent, Moonshine. To know the rationale behind this development and the outlook, Nitish Mittal Sen, joint MD and CEO of Nazara Tech, is here with us on the show. Nitish, thank you very much for joining in. First, give us the rationale behind this, and how does this divestment align with the company's long-term growth strategy?
Sure. As you know, a few months back, we had bought a significant stake in Pokerbazi, which is India's largest online skill-based poker platform. And the thought of selling the open play stake to Pokerbazi is really to consolidate our real money gaming businesses, the skill game businesses under one vertical. The Pokerbazi team is extremely strong, very strong on technology. So we believe that consolidating the RMG business within them makes more sense for us.
How big is the RMG business now for you in terms of overall size? And considering you've always been bullish on it despite all the regulatory headwinds, what is the aligned vision for your real money gaming business under PokerBaazi now?
So PokerBaazi being the dominant player in that space, in that vertical with over 60% market share, is run rating at about, I would say, approximately a net revenue run rate of 600 crores plus, and will continue to grow very well for us. So the whole idea is that any other vertical of RMG, whether it is open play business or casual gaming, skill-based casual gaming, all of those combined would provide a lot of network effect and lower cost of acquisition. So logically, it makes sense for us to kind of concentrate at one area and focus all our RMG businesses over there. That's exactly what we have done, and I think this will be very fruitful for us.
Is there going to be any other intermovement of your businesses, or has all the RMG been consolidated under PokerBaazi?
I think RMG has been already consolidated.
Okay. And what is Nazara planning to do with 104 crore? I know you're very cash rich. What's the current balance? And now with this incremental 104 crore rupees, what are you planning to do?
Yeah. The balance is quite dynamic because we've been very active in, a lot of investments. We recently announced an investment in a very interesting startup called Real Saga. We've also placed a pref which is still to close for about INR 495 crores. I think that money will come in the next month or so. But our primary objective will remain reinvesting in organic growth as well as, acquiring interesting companies. Our current focus is on the gaming studio businesses like the ones we've done in the past. And I think in the coming months, we will make more such acquisitions.
What is your current stake in Moonshine? Who are the other stakeholders in Moonshine? And how is the valuation arrived at?
So we hold approximately 47% stake today. But we also have, a CCPS note which we can convert at our, will to, consolidate this business and increase, over 50%. So we will do that at the right time. The other investors largely are the remaining stake is largely owned by the founders.
Okay. And when are you planning to convert the CCPS and at what price? And then your stake would be 51%.
Yes, I think we will, look at it maybe next year. We're not in a very big hurry on that front. We want to give enough room to the team to, grow the business aggressively. At the right time, we will do it. We don't have a specific timeline. But yes, once we convert it, it will be over 50%.
No specific timelines right now. You had earlier indicated about a 10% kind of a revenue growth for FY25. Does that still stand? And you must have drawn up plans for FY26.
Yeah. If you saw our Q3 numbers, right, which we reported in February, our revenues grew year on year for that quarter 66.7%, and our EBITDA actually grew 39%. We posted our highest ever EBITDA of 52.4 crores in Q3 FY25, and this EBITDA is backed with very strong operating cash flows. So I think we're on the right track, and we will continue to deliver healthy growth in the quarters to come.
And what about the advertising and promotion? That had seen a big jump in Q3. Are you going to continue to press the pedal on marketing? And what's the number as a percentage of sales?
We're seeing very good traction on some of our games internationally, especially west facing into the US. And because these are very profitable spends, obviously, if we can continue to grow it, we will continue to grow. So we don't have a specific target in terms of percentage of spends. The idea is we will continue to scale as much as we can.
And FY26, Nitish, you didn't give us is there a growth number? Is there a top line that you're targeting, margins?
We're in the process of finalizing our AOP right now for the coming year. But I can definitely say that we will be looking at, much more aggressive growth in FY26 over what we have delivered in FY25, both in revenues and profitability.
Aggressive growth in FY26. On revenues and profitability. So we should brace ourselves for margin expansion.
Yes, that's always a focus for us.
Always a focus. In the prior quarter, there was also this one-time impairment on brand scale innovation, Wings as you called it. Any such, because we've seen a slowdown in the market, not particularly where you operate, but generally many of the smaller companies are struggling to grow, etc. So are we likely to see any more impairments?
No, I don't think so. All our businesses are working well and are profitable. we are generally a very conservative company and like to clean up our balance sheet, quickly, and which is why we kind of proactively took this impairment of Wings. There is, as we had disclosed in our presentation, also there's an outstanding loan to Wings, which may get provisioned at some point of time, maybe this quarter or next quarter. But generally, we have a very clean and healthy balance sheet.
Nitish, thank you very much for joining us on CNBC TV18. That's the word coming in on Nazara Tech. For the Nifty, it's down 85 points. The Nifty is at 22,375. On the way up, Sun Pharma, which made an acquisition yesterday, Checkpoint, is up 2.5%. Top gainer, ICICI Bank, comes in for buying. And then there is this full consumption FMCG tilt in the market. Buying emerging in Nestle, Britannia, ITC, HUL. These are stocks where you can see green on the screen. But the problem is IndusInd Bank opened with a 10% downtick, now down 20%. Abhishek is now joining in with more.
Well, Rima, to begin with, internal review process that they have had with respect to asset and liability accounts of derivative portfolio over there, a hiccup has been seen. So about 2.35% of the net worth will get adversely impacted. So it's about 1,580 crore post-tax or about 2,100 crore pre-tax. So they have appointed an external agency to review and validate the internal findings with respect to what has gone wrong. The bank's profitability and CRAR, that is capital adequacy ratio, remains healthy to absorb this one-time impact that they will have from this portfolio. So management in con call did say that the practice has been ongoing for 5 to 7 years now and was discovered as part of a review initiated following new RBI guidelines effective 1st of April 2024. The RBI has been fully briefed on the issue. Initial and final updates have also been provided to RBI. They also went on to say that the CEO's 1-year extension versus 3-year that was sought by the board of the bank acknowledged to be influenced by the issue. So analysts do say that this is a one-time earnings impact but can lead to short-term de-rating of the lender, that is IndusInd Bank. So they have cut earning estimate anywhere between 20 to 25%. Many of them have cut their target price as well, like MK, Jeffries as well as Citi. In fact, MK has downgraded the stock recommendation to add from buy. Now promoters holding is around 16.3% in the bank. So about 50.9% of it is pledged. So we need to be careful or watchful of that as well. Back to you.
Biggest single day fall for IndusInd Bank since March of 2020. That's COVID time. And now the stock is at its lowest level since November of 2020. Thank you, Abhishek, for that. It's over to Vamakshi now for Star Health.
Well, Rima, Star Health is under pressure today, and that is because Ahmedabad hospitals and nursing homes have suspended the cashless services for policyholders of 2 insurance companies, which include Star Health as well as Tata AIG General. Now, these cashless services will not be available for policyholders of both of these insurance companies starting from April 1st. And the reasons the hospitals have outlined for the same include unjustified deductions, low charges reimbursed, non-renewal of tariff rates, as well as one-sided blacklisting of hospitals. So given this development, the stock, that is Star Health, is reeling under pressure as of now.
Thank you very much for that. Nifty IT index is down 1.5%, feeling the heat from the 4% Nasdaq fall, but Persistent is still up in the green. Sudarshan's joining in, tracking the upgrade on Persistent and Escorts Kubota.
So while following the market trend and global cues, Escorts Kubota and Persistent are down in trade today, but CLSA has come out with a positive note on both these stocks. CLSA maintains outperform call on Escorts with a target price of 3,805, implying an upside of more than 25% from current levels. And CLSA has come out with a note, and it's after the CLSA has met the management of Kubota Japan. What did it say? That Kubota Japan remains positive on growth outlook for Indian farm industry and expects growth in the range of 6 to 7% even for FY26. Do remember that companies have been saying that for FY25 also growth for the tractor segment is seen in the range of 6 to 7%. So if in FY26 also growth comes in the range of 6 to 7%, it can be seen healthy. Also, it says that company expects to gain market share with the launch of Farm Track brand and current market share is around 11.5%. Now it expects to rise to 13% in medium to long term. Second is CLS on persistent. It has upgraded to high conviction outperform, and target is 9,267 per share. It says it sees AI is sparking a new tech cycle, and it's going to benefit most of the IT company, and that's the reason it has upgraded persistent.
Thank you very much for that. There is a small recovery underway. From being down to levels of 22,314, the Nifty's managed to recover nearly about 100 points, so trimming its losses and now above 22,400. Get into a break, but don't go anywhere, because on the other side is our market editor special, one of the biggest bulls in the India story. Morgan Stanley's India equity strategist Ridhan Desai is our market editor.